Thank you, Nirav. Good evening and a warm welcome to all the participants. At the outset, I know that it's 6:15, 15 minutes behind schedule. We had another meeting we had to conclude and come. Apologies for that, but we'll take as many questions and possible and extend where required. With that, without much ado, we straight go into the opening remarks by our CEO and MD, and then we have our DMD Kaizad. Any comments we'll take, and we'll go straight to Q&A after that. Sashi, over to you first, and then we'll take it from there.
Good evening, friends. Thank you very much for joining in on a Saturday evening. I know it's rather late, but always appreciate your being here on a Saturday evening. I think we've just sort of declared the results, and you probably would have seen the financial numbers. We're reasonably sanguine and happy about the outcome that has happened. It's in line with our expectations. Looking back, I think the credit growth build-up has been extremely encouraging. We set our sights on a very balanced credit across customer segments. The easing rate cycle and the benign credit has provided catalysts for the credit growth. The CRR release enabled credit deployment slightly ahead of our expectations. As regards funding, the funding through deposits, we continue to maintain rate discipline, and that has been extremely key. Core individual retail customer segments were seen to be quite strong. For both current and savings, having focused on granular segments have given us encouraging outcomes, and more of this, I'm sure Srini will sort of give the numbers. We did, however, fall short of our strong ambitions, but we are confident that continued focus on our strengths will bring the expected outcomes. On the growth, profitable growth, as mentioned earlier, cost of funds has moved down, reflecting the tailwind effects. CASA growth has been positive. Cost has been under control as productivity improvements have brought in efficiencies. Credit, which has always been our USP, remains best in class, allowing us to deliver stable returns as we pivot to the next stage of growth. Looking ahead, the regulator and government continues to be focused on supporting economic and credit growth. At the same time, optimally managing external factors. During the quarter, availability of liquidity was impacted due to some of these. We saw enhanced activity in open market operations and FX swaps to combat some of these challenges. India has demonstrated stable political conditions and consistent policy regime. This has led to being one of the fastest growing major economies in the world. Growth with subdued inflation management was at the top of the order, and hence we believe and we are very optimistic about outpacing loan growth in the coming year in FY27, as we had sort of mentioned to you all along for the last 18 months. Liquidity and benign credit costs provides us a lot of runway to grow. Overall, liquidity in the country is expected to stabilize post-trade deals. The foundations are in place to build deposits to fund loan growth. We continue to expand our customer base. We are now intensifying customer engagement primarily and largely focused on granular mobilizations. We are aligning pricing with segmented approach, and we shall see that in the coming quarters as well. There's been a lot of talk on the CD ratio. We did sort of drop our CD ratio to significantly since the merger to March 25. As you know, the kind of indicator is not necessarily on the radar from a regulatory perspective. Having said that, we believe that our glide path to lowering of CD ratio will continue. It's an important focus for sustainable profitability, I completely acknowledge. The easing cycle with credit growth focus in the country surely needs our participation. So the speed of CD ratio movement depends on how we are able to provide funding in the system at rational rates. But having said that, we're very confident that whatever we seem to have committed in the last 2 years, I think by March, we should see, and by March 27, 26, and 27, we should sort of achieve most of the committed matrices that we have laid out for. I would like to say that under the current scenario, we don't think that we shall be constrained by the CD ratio. To reiterate, we're confident that it will be on a downward glide path. I would also like to reiterate that we shall meet the glide path that we had indicated earlier in terms of the growth, our top-line growth, which is in line with the system this financial year and faster than the system in the next financial year. In summary, I have a great appreciation for our customers for partnering with us, and I have the greatest gratitude to all our 200,000 staff who are pillars making this place work successfully. We're confident of the path forward that we have set for ourselves. Thank you very much, and we have all of us here, Kaizad, Srini, and the team here to take on any questions that you may have. Thank you.
Thank you very much. We now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from line of Maru Gajania, an analyst. Please go ahead.
Hello. Hi. So my first question is on the LDR. You did allude to it. But when do you think now you would reach an LDR, say, close to 90 or below 90? Like any time frame? So that's my first question. And my second question really is on agri compliance. So 2 large banks have been asked by RBI to make provisions on a certain agri portfolio because of non-compliance issues, provisions of 12 to 13 billion. So as we stand today in terms of your agri portfolio, do you think there is full compliance, or there could be some issues somewhere, given that it's a large portfolio, it's spread out across the country? And do you think you would be liable to such provisions in the future?
Okay, thank you, Maruka. If I take that. The first thing you touched upon is the LDR from a timing point of view. I think Sashi alluded to that we are committed on the glide path of taking it towards the downward glide path, and we continue to be in that, but on a quarter-to-quarter basis, it is slightly different. And that's because of the seasonality and the opportunity. And you know that in the recent time period, the further opportunity was also provided with the easing cycle and the credit growth focus in the industry, as well as the CRR release, which provided that ample opportunity to do that. So given that, we do expect that over the next 1 year to 2 years, we would be getting down further into the levels that we have previously been there, call it the 90s or low 90s and so on. And that's the level of confidence we have, and the pillars that are required to drive that are in place to do that. That's one. The second one is in terms of the agri that you asked about, with the regulatory kind of impact, if any. Our regulatory inspection is also complete, and whatever required according to the regulatory requirement, there was about 5 billion or so thereabouts, which have been taken. In the overall context of our book and our results, if you see, they have been absorbed within that, and there is no special. And we've had certain other things that were there. And so in future, we need to operate in a model that is acceptable with the regulatory, so that whatever is that's an ongoing process of what we do. Any one time is already subsumed, and it is not there. And as far as the calibration that we need to do on the agri, consequent to those kind of things, recalibration of our book due to the scale of finance, so that what is indeed an agri and what is outside of the scale of finance. Scale of finance is the one that determines how much is required for the farm and how much of that is over and above the farm requirement by the farmer. Those evaluations we will take and go through that process to calibrate that. That's in terms of the future impact on that.
But did the 5 billion come this quarter only then?
Yeah, it is already subsumed in December.
In December. Okay, and what would be the size of the portfolio? Any such indication you could give?
Our agri portfolio is published. You'll be able to see the...
No, the size of the portfolio on which the provision was taken.
No, that's not something that's not consequent to this at all, because it depends on loan item and what is the scale of finance on each one and so on. But at an aggregate level, that's the kind of level.
Okay. Thank you so much. Thank you.
Thank you. Next question is from man of Concall from Citigroup. Please go ahead.
Yeah. So again, getting on to the question on LDR and deposit growth in particular. So if we want to get the LDRs down and still want to grow loans above the industry average comfortably, then we need to see the acceleration in the deposit growth. And you said like pillars which are required are very much in place. So any reason maybe for a slightly slower deposit growth this quarter? Otherwise, we will need like almost 500, 600 basis points higher than the industry average deposit growth now to get the LDRs down. And any rundown in the bulk deposits which have been there in this quarter, and if you can quantify that?
See, let me take this, and maybe Srini and Kaizaf can add into this if required. Kunal, if you recall, we gave a broad range. Number one is there is no regulatory, benchmark or a requirement to meet a loan deposit ratio. Was it there as a bit of a nudge when the outlook was negative, or when the system outlook was little tight, liquidity was tight in the period when inflation was moving up and rates were moving up, and there was a little bit of a concern on the credit quality of the system? There were certain preventive measures that the regulator had said that try and ensure that you bring down the LDR or maintain a certain stability in LDR. That is at that point in time. Whether there is a number that you need to meet, I don't think there is any compulsion. But in our own interest, we had given a kind of a glide path wherein we had said that we will come to a certain number in FY25, which we achieved. We said we will try and be in a range of somewhere between 90 to a 96 in the year FY26, which is what we will be, is what we are very confident about. And then maybe by FY27, by the natural growth, and even with the growth in the way we are expecting in terms of faster growth rate, I think we should land somewhere around the 85 to 90 for FY27. We continue to believe that this is going to be there. But it's not an easy thing, as we have said, of course. But we know what are the strategies we need to do. There were certain tactical measures we could have taken in the third quarter. We chose not to, but that's all right. I mean, these are sometimes learnings we probably may have missed, but we know what are the things to be done to bring about these kind of meeting our glide paths that we have committed in the broader sense on a medium to longer term basis. So as regards the kind of deposit growth that is required, I think the pace at which we are growing deposit in line with the top line growth, that is more or less matching 11% plus in this year should and probably slightly faster, which is what we normally do in the fourth quarter, like what we have done in the past, should lead us to the kind of range that we have committed to. And we are very confident that once as we have a clear-cut, as I said, all things remaining same with whatever we are seeing in the macro, we should believe that the growth runway opportunities for growth and hence in the deposit requirements, other than certain events that may happen which you and I will not be able to predict now, we are reasonably confident that we will land overnight. And as Srini mentioned, don't look at quarter-to-quarter movements. We are on a, look at on an annual basis or on a medium to long-term basis, the trends will be in that kind of period. So I think the inflection has started. We had to contain ourselves in FY25 for all the right reasons. I think now we are opening up. The engine is opening up, and you will start to see this kind of a consistency in the trajectory that we have laid out for ourselves.
Thank you, Sashi.
Sure, and anything on bulk deposits rundown, quantification if possible?
More than quantification, Kunal, that's part of the business. There are certain segments that we patronize. I think Sashi mentioned about where rate discipline has been the key, and to some extent we participate for relationships. To a certain extent, we don't need it, we don't go there. But on the whole, if you look at the retail or non-retail, there are individuals in retail which have been phenomenally
growing.
There are certain non-individuals in retail which is branch related. It could be institutions, trusts and HUFs and whatnot. Right? Examples of some non-individual but branch related, where we have had some lower levels of growth. And there are certain other customer segments which we have seen, particularly capital market segments, where it has been low, where we have not paid rates as much as what the market has demanded or what the competition is offered. And that is what you see that is reflected in our cost of funds. If you look at our cost of funds, is down by about 10 basis points, 11 basis points or so in the quarter. So we're trying to manage it, growth with the profitability, and that is what you're seeing, right? So segment to segment, time to time, it changes, but at least you got a color of how we operated in the recent time period.
So you're right, Kunal, just to supplement what Srini is saying. The focus, the good part is retail has grown very steadily and all these are the granular ones. Very happy with that. If the non-retail, tactically, we did not sort of offer the kind of market rates that were there. We said it's all right because we did sort of know for the kind of growth that we needed, that is good enough.
Got it. And one last question on labor code. So the impact of almost 8 odd billion, looking at our employee cost, then comparing maybe the labor code impact vis-a-vis the employee cost for others. For us, it seems to be relatively on the higher side, more than 10% of the employee cost, not so much for the other banks. So is this more of an estimation which has been done, and what would be the recurring impact which would be there on the cost as such?
Good point. Thanks for raising that. One, it is an estimate given whatever information that we have. And that estimate is driven through an actuarial process, right? So you go through the normal process of how you do, and that there is an actuarial valuation and determination of how do you do. Again, there is some science in that, but it's based on certain assumptions that come. That's the second thing. The third thing is that variables. When you look at these variables, the definition of what is wage, what are determined to be wage, inclusion, exclusion, the rule making on that is pending. You know that, right? So that there are some assumptions that go. One of the variables that go into those is assumptions, and that is not based on determined rules. That is based on some assumed thing. So that's the third thing. The next item is that individual organizations can be very different. Because of the longevity of the staff that you see there. So that determines on how long and what is the kind of tenure and so on and so forth. both historical and anticipated. And so many other factors like that go into play. So at this time, I would just ask you to take it as a higher estimate based on best available information and through a scientific actuarial process that has come. And as and when the rulemaking evolves, as and when more information is available, this will be evolved. And again, I can't venture to come out with a forward-looking or what impact on an ongoing basis. Cannot do at this time. And the reason being that we need to have all of these in place before we can get there. And that is why this is not determined at an employee level to say next month when somebody retires, this is the kind of amount that it can come, or what will be the amount determined for a provident fund, and so on and so forth. It cannot be determined at this stage. This is a really high level based on this estimate.
Got it. Thank you. Thanks and all the best. Yeah.
Thank you very much. Next question is from Chintan from Autonomous. Please go ahead.
Hi, good evening. May I get into the LDR again, please? Sashi, please, did I hear you correctly when you said 85 to 90% by FY27? That seems to be aggressive to me. If I look at consensus numbers, it's expecting 13% loan growth and 93% LDR. If you are going to achieve kind of the 90 in the next fiscal year, that suggests a very strong deposit growth number. And I know you've kind of said that you want to prioritize growth now. So it's not piling up. So if you could help us in the circle.
Chantan, thanks for asking. Maybe then I've given you a broad range because I don't want to box myself with a narrow range. But having said that, we have been operating in a range of around the 87, 88 in the pre-merger levels, 3 years before the merger. Yeah. And so when I say 90, of course, I would have meant somewhere around the plus or minus in that particular range of 90, maybe around the 88, 89, etc., or it could be 90 to 91 as well. But why I mentioned is at least, the trend lines that we are saying, if it can be 96 for FY26 or a 95, we are all right. At least the direction is what we are looking at for. We just gave a broad one so that we know what, if we are lucky to really step up growth or the liquidity changes and we have more benign liquidity and no FX operations or FX swaps or open market operations, maybe then it will be wonderful. So that is why I'm saying since I do not know what's going to be the liquidity condition in this, therefore I gave a broad range. But even if I achieve these kind of directionally going there, that's something that we can achieve. As I said, there is no regulatory number to comply to. It is just a direction that I think we need to achieve for ourselves, let alone the regulator asking us to do. It is something that we believe just by doing what we're supposed to do will lead us to that kind of thing. I don't have to do anything extra to measure that metric. It will happen. So when we did sort of forecast a faster growth rate in the system for ourselves than the system, we also, as we have seen, we have been having deposit growth rates in line with normally the top line growth, slightly faster than the loan growth. So estimating that is what we believe where we will land for FY26 and 27. So don't take it literally that we may be on the lower end of that range. It could be anywhere in that range. Practically speaking, it will be somewhere at the, if it's 90 is that range, then somewhere around the 90 is something that we'll be happy with. Similarly, somewhere around the 95 is something that we'll be happy with for FY26.
Appreciate that. I mean, if you're trading off EPS growth for slightly slower ROA improvement, that's fine. I mean, that's not the issue, especially if the opportunity is there in the market. But I just wanted to make sure because, we have an occupational hazard to kind of do our due diligence in our models. So just wanted to get that flexibility that you have highlighted now. The second question was around asset quality. Could you've got a unique vantage point, second largest bank in India. Could you give us some idea about, any pickup in growth momentum, any issues in asset quality, particularly due to the U.S. tariff or in the MSCI area? So it's a combination of, is growth improving and are there any asset quality concerns more broadly, if not in your book?
So if I got the question right, you want to know the trend for asset quality and how it is looking. Across segments and even first at the sectorial, you're well aware that, the banking industry right now, to borrow a term, is going through, a Cinderella phase where you've got very strong balance sheets. When I refer to that from an asset quality point of view, you have the lowest accretion of gross NPAs and net NPAs are at decadal lows. Mirroring this trend has also been, reflective on our books. We have seen, very low accretion to gross NPAs, and none of the particular portfolios have indicated any stress building up. So I think the economic environment with the kind of GDP growth that one has seen, the kind of consumption growth that one is seeing, as well as the wage increases that one has seen on one hand, and on the other, the lowering of the interest rates and affordability, therefore going up, including the fiscal benefits that were given, to not take up much time, I would say the asset quality continues at the bank to be pristine, and as we see it, there is no particular segment which is showing any major signs of concern. Srini, would you like to?
Perfectly good. There will be seasonality in agri.
That is a separate.
Outside of that, every segment, including the agri segment, period to period, if you see, is lower, both from a leading delinquency and into the slippages, which are far lower. And then from there going into loss given default is also lower. You're seeing that the recoveries, wherever we are, that is also on an absolute level, good level. Chintan, hope that gives you a perspective on both sides.
Yeah, thank you. And just on growth momentum, are you seeing things improve generally in the economy?
In the economy, the growth momentum, yes. If you look at some of those indicators that you have seen, take the crop cycle itself, very improved. The sowing cycle is improved over prior year. Very healthy water reservoir levels have aided that. The manufacturing PMI continues to be in the expansionary zone with many programs that are coming in. Services sector doing very well on the.
today about 50% of branches, which is this 4,800, is contributing around 20% of incremental deposits. Is it correct to think that when this starts contributing maybe 40-50% of incremental deposits, that is when you start thinking about future expansion? Is that the right way to think about it?
Whether it's 40, 50, 60, we will keep on recalibrating because there are a lot of things that we are trying to do. Obviously, we also, if you really look at it, we stepped up our distribution the moment we knew that we announced our merger. And we knew that we needed to, fund not just at that point in time, the future of, in the future. So all this is going to add to incremental deposits in a substantial way into the future. But, so there will be a lot more dimensions that we will examine, not just the extent of contribution, but probably, certain events that we may have or certain other dimensions that we may look at before we start to step up the pedal on the new phase of incremental. And, you look at it even over our 30-year period, there have been these phases of, right from 2009 onwards to 2013-14, we stepped up our distribution. Then we had a little bit of a pause. Then we started off again. So, this recalibration and doing it in phases is something that we've been doing. It's not a new thing. We've been doing this for right through our 30 years journey. And I think we will continue to do. Obviously, the dimensions keep changing in terms of what we need to look at as we move ahead because the world is changing very fast. The kind of technology implementations that we are doing, as we unveil, we probably may need different thought processes as well. So let me pause out here and you probably will get the drift.
Sure. Thank you for that. And the second thing is on credit costs. Now, if I look at your net slippages, X of the agri part, but let's say look at the net slippages in the 9 months or last few quarters, around 30-35 basis points. Write-offs are holding steady at 3,200 crores roughly a quarter. So why is the underlying credit cost at around 55 basis and not coming off? I mean, don't you think that should also start coming off at some point? If this kind of
Abhishek, a couple of things. One is the slippages. If you're looking at excluding agri slippages, it's 24 bips in the quarter. Prior quarter was 23 bips. Prior year was 26 bips. So, order of magnitude, call it 25 basis points. That is the kind of a slippage in a quarter, right? That's what you're seeing. So, not the 35 or something that you're talking about. That's one. The second thing is that credit costs, also you have to look at it including the recoveries because when you write off certain loans as it progresses through some of the delinquency buckets, then you get it in the form of recoveries. And net of recoveries, if you see, we are at about 37 basis points or thereabouts. And when you look at, again, last quarter, last year, order of magnitude very similar, within a few basis points, 5 basis points. So it's not just about the 55 basis points, it is also about the net of the recoveries, which comes in quite handy. And it's a function of how fast you write off and how you recover.
No, sure, that's what I was referring to. So net of your recoveries, etc., it should keep coming down because your slippage performance is, it's improving. The book is growing and your absolute is pretty much stable. So you're seeing very good asset quality trends. And I was sort of wondering why the credit cost is not coming off. Yeah.
No, why will it? See, when in a growing book, if the slippage is steady, the losses are steady, recoveries are steady. I don't know what you're expecting. Maybe something else.
So 50-55 is more or less BAU, is what you're saying.
No, GNPA?
No.
No, credit cost.
Yeah.
Okay, I'll take this offline. Never mind. I'll probably not explain myself clearly. No problem. Finally, just one question on cards. Overall card receivables are pretty stable. If I look at, the data that comes out in RBI, the spend market share for you is doing well, SIF market share is doing well. So why is it not reflecting in the receivables? Is it just transactors running down, or is it something else?
So actually, great question, Abhishek. I think if you really look at it, the segment that we are patronizing is more the middle and upper middle segment. Therefore, slightly higher end cards is what is in our portfolio. The proportion of that is large. And a large part of that, over a period of time, we have been, as you know, the credit card, what shall I say, the behavior has also changed over a period of time. Today, we look at it not as a net receivable from a revolve perspective, from a asset perspective and an earnings perspective. We are looking at it as an enabler for our liabilities or deposits. Srini has mentioned in the past, and that is something that we are extremely proud of, the spends in the cards actually provide a significant portion of our deposit momentum. Today, 20 to 25, maybe in the mid of 20 to 25, I can say, is the range at which out of the total deposit basket, the kind of momentum that you're seeing, whether it's on the healthy balances and what it contributes to total, it's somewhere around that 20-25. So the credit card focus today is more not from a net receivable basis, but from a transactor basis. And, as I said, whether it's a lot of you on the call or people in this room that we all pay, on a standing instruction basis on due dates. So this is something that we are very happy with. And so this is the kind of a new strategy that we are evolving. Obviously, we are also recalibrating some of the business model and cards. We have been doing that, and we probably have come out with something which is very encouraging and something that the organization will really benefit from our card strategy.
So, thank you so much for answering.
I want to add one thing on the cards, particularly the card revolving aspect of it, right? Which is, if you go back to 2020 or before and compare to today's revolvers, they are less than slightly under 2/3 level, right? Slightly under 2/3 level. So that means of the pre-2020 levels revolvers, right? At level. And so the profile of the customers, and that is why you see the deposit balances of those customers, which is little more than 5.5 times, was slightly under 4 times at that time. Right? So the profile of those customers are also different, where they do transact, they do keep balances, and the revolver balances are lower for certain other segments. And we have not liberally offered credit line increases and made more and more revolvers to tip them off into delinquency. Credit has been cautious on that. Yeah.
Got it. Thank you so much for answering all those questions, and all the best. Thank you.
Thank you very much. Next question is from one of Jayant Korde from Axis Capital. Please go ahead.
Thanks for the opportunity. So one question is on your loan growth broad guidance of above system next year. So just wanted to understand, when we are saying we'll grow above the system, what is our range of assumption for system growth? Because we are seeing some acceleration in the system growth itself, where we are moving from this 11 to 13 band to maybe closer to 14, 15. If we were to move in that band, would we have accounted for that kind of a system growth when we say we can grow about that? Yes.
So our understanding as of now is next year we expect system growth to be between 12 to 13%. When you look at nominal GDP and the credit growth that's required to support nominal GDP. So if we're talking about 12 to 13%, we are talking about a couple of percentage points above that going into the next year. We see distribution on the retail side you've been seeing, over the last 2 quarters coming up, our positioning also in the MSME space, given our geographic coverage as well as our suite of products that we have out over there, and, the wholesale piece, which you would have seen in this quarter, again coming back. We do believe that we have the customer segmentation to be able to grow at a couple of 100 basis points over system growth next year.
Great, sir. I think this answers the working with the 12 to 13 range at least. Second part is, sir, on a broader 3-year or 4-year question. We have seen products like mortgage getting a lot of competitive intensity. PSA banks being well capitalized are, probably being more aggressive in vehicle increasingly, auto. Do you see this competitive intensity eroding profitability for the larger players over the next probably 3 years, and not a 6-month or 12-month question?
Yeah. See, we are addressing competition only through relationship and not through pricing. Mortgage product is you've seen that in the last 12 months. We are not leading through a mortgage product. We are leading through a relationships where the mortgage product could be a fulcrum around which we can operate. Same with auto. I do want to let you know that our auto loans are almost little more than 80% self-funded, which means the customers, when they take auto loan, we want their liability accounts, we want them to have balances in that, and the loan self-funds itself for most part within the balance sheet. So it is about relationship offering, and that is part of the engagement in the branch, and it's not just a product and a loan balance sheet building approach.
Having said that, Srini, absolutely in order, I think, we do continue to be the largest financiers in the auto loan space in the country, not only in terms of the disbursals, but also the book size, as well as, if you see our year-on-year growth in the entire automobile space, I think, that is reflective of what our position is and the target market that we will have. So it is relationship. It is also ensuring that we have the right pricing for the product based on the customer segmentation, and we don't feel any need to, do business at price points which don't make economic sense.
And your market reading is, as of now, we are not in that situation where aggression is eroding margins for the broader system, at least in auto.
I'm sorry, I didn't catch your question. Can you repeat it, please?
So not for HDFC, but probably for broader system. Are you seeing that aggression in auto segment from the public sector or maybe the broader system aggravating in the last couple of quarters?
Yes, we've seen it not only in auto, but also in the home loan product. So, these are two products where we have certainly seen, some amount of, if I may say, a bit of irrational pricing. But, irrational pricing has never sustained. It will, play itself out and bury itself in a couple of quarters on the outer side, if not earlier.
Great. This is very helpful. Thank you and all the best.
Thank you.
Thank you very much. Ladies and gentlemen, we have come to the end of the allotted time for the call. I would now like to end the conference to Mr. Vidyanathan for closing comments.
Okay, thank you, Nirav, and thanks to all the participants for taking the time to attend. At the outset, I again want to mention that we did come 15 minutes late. We did extend to be there. Further questions, any more comments, Investor Relations team will be on standby to guide and help and explain or clarify anything you need. Today or the weekend or next week, whenever you desire, we are available. With that, we'll sign off for today. Have a great weekend. Bye-bye.
Thank you very much.
Thank you.
Thank you.
Thank you all. Thank you very much for all the hard work. Thank you.
Thank you, everyone. On behalf of HDFC Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.